Welcome back to Red Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie. Great to be here.
So this week, another dive into the key developments. We're looking at the Bank of England, the Woodford fallout, new safeguarding rules.
And a bit on fintech, too, with Revolut and open banking. Quite a mix.
Absolutely. The aim, as always, is to pull out what really matters for you, working in retail banking to keep you informed and, well, ahead of the game.
Precisely. Shall we kick off with the Bank of England's rate decision?
Let's do it. The big macro picture first. So they announced another rate cut. Expected, perhaps, but the details are quite telling.
Yes, the Monetary Policy Committee, the MPC, they've decided to cut the bank rate by another 0.25 percentage points. That takes it down to 4%, effective August 6th, 2025. And as you mentioned, this is actually the fifth cut this year.
The fifth one? But it wasn't unanimous, was it? That vote split seemed, well, tighter than some expected.
That's right, a 5-4 split, which, does raise an eyebrow.
So what does that tell us? Who was for and who was against?
Well, 5 members voted for the cut. That includes the governor, Andrew Bailey, plus Sarah Breeden, Swati Dhingra, and Dave Ramsden. But 4 wanted to hold rates at 4.25%. That was Megan Green, Claire Lombardelli, Catherine Mann, and Hugh Pill.
Interesting.
And even more so, Alan Taylor, who's often seen as quite dovish, apparently argued for a bigger cut, 0.5 percentage points.
Really? So quite a bit of disagreement there. Not just a simple decision then.
No, not at all. It suggests, I think, a real difference in opinion about how quickly inflation is actually falling away, or maybe how much risk they're willing to take stimulating the economy versus, keeping a lid on prices.
So for banks, this means policy might be a bit unpredictable. Need to keep a close eye on the data?
I'd say so, yes. The consensus isn't rock solid.
Okay, so given that division, what was the main justification for going ahead with the cut?
It really boils down to the economy. It's struggling a bit. UK GDP growth, well, it was estimated at just 0.1% for the second quarter of 2025. Very subdued. And the labor market is also showing signs of, as they put it, gradual loosening.
Meaning unemployment ticking up slightly.
Exactly. So there's this feeling there's a bit more slack in the economy, room to grow without immediately sparking inflation. The cut feels like they're trying to get ahead, prevents a sharper downturn, perhaps.
But, and this is the slightly confusing part, they cut rates despite upgrading their inflation forecasts. How does that work?
It is a tricky balance, definitely. CPI inflation actually rose to 3.5% in Q2 2025, and now they expect it to peak at 4.0% in September. That's double their target.
Double the 2% target. Wow.
Yes, and they're putting that down to developments in energy, food, and administered prices. So things like utility bills, groceries, council tax, that sort of thing.
And I remember the governor, Andrew Bailey, had a specific comment on food prices, didn't he? Something about harvests and policy?
He did. He said it was roughly 50-50, half due to poor harvest pushing prices up, and half due to government policies like higher national insurance and living wage costs being passed on.
That's quite a breakdown. And food price inflation hitting 5.5% this year. That's significant.
It is, and the MPC is definitely watching how wage pressures feed through. So it leads to the key question for our listeners. How does this specific rate cut impact retail banks directly?
Well, the immediate reaction came from the Chancellor, Rachel Reeves. She welcomed it, saying it helps lower mortgage and loan costs.
Right.
So for banks, that means looking again at mortgage pricing, potentially seeing more demand there. Same for SME lending. Lower costs might encourage businesses to borrow.
And the flip side, savings rates.
Exactly. That's the other side of the coin. Rates on savings products will likely feel downward pressure. Managing that, keeping depositors happy while adjusting to the lower rate environment, that's the challenge.
It's a constant balancing act. But the MPC is being cautious about signaling more cuts, aren't they?
Yes, very much so. They stress they're not on a preset path. Future cuts depend on seeing clear signs of underlying disinflationary pressures.
And they mention global factors too, things like trade tariffs.
Indeed, that unfolding tariff situation was mentioned as a factor adding uncertainty. So it's complex. Supporting growth, but still worried about inflation sticking around.
A real tightrope walk.
Yeah.
Okay, let's shift from the macro view to some very specific regulatory actions.
Yes, time for our regulatory deep dive. First up, the Woodford Fund collapse. The FCA's final ruling is out, and it's pretty heavy.
It certainly is. Neil Woodford himself fined $5.89 million, and he's banned from senior manager roles in managing retail funds.
A significant personal penalty. And the firm?
Woodford Investment Management, BoE, fined $40 million, so together that's nearly $46 million in total penalties.
Oof, that sends a message. What were the core failings the FCA pinpointed? What fundamentally went wrong?
The FCA found Woodford had, and I quote, a defective and unreasonably narrow understanding of his responsibilities, and that he made unreasonable and inappropriate investment decisions. You just have to look at the fund's value. It dropped from over $10 billion down to $3.6 billion before suspension.
And the central problem was liquidity, wasn't it?
Absolutely. That was the crunch point. He was selling the easier-to-sell liquid assets and buying less liquid ones. By the time the fund was suspended, only 8% of its investments could be sold within 7 days.
Just 8%, when investors are meant to be able to get their money out within 4 days?
Precisely. A clear breach. And crucially, the FCA says Wim and Woodford did not react appropriately as things got worse. A failure of oversight.
The suspension itself, June 3rd, 2019, trapped around 300,000 investors, many just ordinary retail customers.
Yes. And then Link Fund Solutions, the authorized corporate director, or ACD, decided to wind the fund up in October 2019. That resulted in that huge shortfall, around £1 billion, about 30% of the fund's value wiped out for investors. Truly devastating.
And there's still disagreement about who's ultimately responsible.
There is. Woodford and Wim are challenging the FCA. They argue it was Link's decision to liquidate this disorderly fire sale that caused the big losses.
But the FCA disagrees.
Strongly. The FCA maintains Wim had substantial responsibility for managing liquidity, and that Woodford prioritized his investment strategy over taking necessary action.
So the big takeaway here for fund managers, and maybe even for banks overseeing funds.
It seems to be that managers can't just rely on the tools or processes set up by the ACD. They need to take deep, proactive ownership of liquidity risk themselves. It's a reminder that judgment and responsibility really matter, even with lots of rules in place.
A very stark lesson. Okay, let's move on to another key regulatory change, new safeguarding rules for payments in e-money firms. What's driving this?
The FCA is bringing in a supplementary regime. Why? Because they found insufficiently robust safeguarding practices, putting consumers at unacceptable risk. The stats are quite worrying, an average 65% shortfall in client funds when these firms went bust between 2018 and 2023.
65% shortfall, that's huge.
It is. And this sector is massive now, holding $26 billion in e-money, $6 billion in payment funds daily. So protecting that client money is vital.
Makes sense. So what are the main changes firms need to prepare for? They come into effect May 7th, 2026, right?
Correct. 3 key areas. First, better books and records. Firms have to do safeguarding reconciliations at least once each reconciliation day, basically daily checks.
Daily. Okay.
And they need a resolution pack, essentially a plan ready to go so client money can be returned quickly if the firm fails.
Right, like an emergency kit. What else?
Second, enhanced monitoring and reporting. Some firms will need annual audits they're safeguarding compliance, though there is an exemption for smaller firms holding under £100,000 in relevant funds. Plus, a new monthly regulatory return to the FCA. More oversight.
Okay, and the third area?
Strengthening the safeguarding practices themselves. Firms need to do proper due diligence on third parties holding funds, check them regularly, think about diversifying where funds are held. Also, ensuring safeguarding insurance policies pay out properly if needed without tricky conditions, apart from insolvency itself. And having contingency plans ready before insurance expires. It's all about being prepared.
So, more robust checks, reporting, and planning. You mentioned something about a post-repeal regime being paused.
Yes, that was a longer-term plan involving a statutory trust for client funds. It's been put on hold for now after industry feedback. The immediate focus is this new supplementary regime.
Got it. So for our listeners in retail banks, maybe they have their own payments arm or work closely with fintechs. What's the direct impact here?
It's significant. If you run your own e-money or payment institution or partner with one, expect a heavier compliance load. More focus on transparency, more checks needed on partners. Your risk teams will need to really scrutinize counterparty risk with any payment firms you work with. And operationally, embedding that daily reconciliation is key. It's about building trust, really, across the whole system.
Okay, crucial points there. Let's move to our final segment, fintech and market developments. Starting with Revolut. They've switched auditors.
Yes, big news for them. They're hiring EY, Ernst & Young, from 2026. This ends what's been described as a tense relationship with their old auditor, BDO. You might remember BDO delayed signing off Revolut's 2021 accounts, which caused quite a stir.
I do recall that. So this move is about smoothing things over with regulators, trying to finally get that full UK banking license.
That seems to be the main goal, yes. to soothe nervous regulators and clinch a full license. Getting those audited accounts is a major hurdle they need to clear.
And there is some political intrigue mentioned in the source material, too, involving the Bank of England governor and the chancellor.
That's right. Reports suggested Governor Bailey stepped in to cancel a meeting between Revolut bosses and bank regulators, a meeting apparently set up by Chancellor Reeves. Now, the report said this raised questions about political interference, especially since Mrs. Reeves has previously criticized regulators for too much red tape. We're just reporting what the sources stated here, of course.
Understood. But it adds another layer to the story.
It certainly does. And the stakes are high. Revolut's valued at, what, $65 billion? Seen as a UK tech success story.
Exactly. So the fact they're still struggling for that full license has apparently got Downing Street worried about the UK's image as an investment destination. This auditor change isn't just procedural, it's highly strategic.
Definitely. Okay, shifting slightly now to open banking. The FCA shared feedback on the future entity. What's that all about?
Right, the future entity. This is set to be the main standards body for open banking here in the UK.
It'll be a nonprofit, setting common API standards, keeping an eye on performance, making sure firms stick to the rules, handling directory and certification services.
Okay, and its immediate job.
Is to support the rollout of variable recurring payments VRPs for some household bills later this year, making things like paying energy bills potentially smoother.
That sounds genuinely useful for consumers, and the bigger picture benefit for the UK.
The idea is that open banking can boost economic growth. How? By making payments faster, cheaper, and more efficient. And it lets firms create new products and services, helping people manage their money better or pay for things more easily. It's about efficiency and innovation.
And how's this future entity being set up? Is it just the FCA?
No. The FCA is working with the industry and other stakeholders. The aim is to get it established by the end of 2025. And it won't be the only player. It'll sit alongside commercial open banking schemes that can offer more specialized services built on those common standards.
So bringing it back to retail banking, how does all this open banking evolution affect our listeners day to day?
It's fundamentally changing the landscape. For traditional banks, it's an opportunity. You can use these standards to make your own payments faster, maybe cut costs, develop new integrated services for customers. But it's also a challenge. More competition from agile fintechs, the need to adapt your own systems to connect seamlessly. Your product teams really need to think about where they can add value in this more open, connected world.
Okay, lots to digest there. Let's quickly recap the main points we've covered today.
We looked at the Bank of England's rate cut down to 4%. But with that interesting 5-4 split showing internal disagreement.
Then the major regulatory action on Woodford hefty fines and a ban highlighting liquidity management failures.
Followed by the new safeguarding rules for payment and e-money firms, demanding daily reconciliations and better planning.
And finally, the fintech updates. Revolut's auditor switch aiming for that banking license, and the ongoing development of open banking with the new future entity.
Each piece shaping the environment you're working in.
Absolutely. We hope this deep dive helps you join the dots and think about what's coming next.
So until next time, as you navigate these shifts, interest rates, regulations, technology, remember that being adaptable is key.
Stay sharp and stay compliant.